Hey Taylor, have you noticed how many companies are doing share buybacks lately?
Absolutely, Alex. It's a strategy that's been making waves. But why do they do it?
Let's break it down. A share buyback is when a company repurchases its own shares from the market.
Right, and by doing so, they reduce the number of shares outstanding, which can increase the value of the remaining shares.
Exactly. Fewer shares mean higher earnings per share, which can boost the stock price.
There are several reasons companies do this. One is to improve earnings per share, making the company look more attractive to investors.
And it's also a way to return capital to shareholders without paying dividends, which can be more tax efficient.
Plus, it signals confidence in the company's future. Management believes the stock is undervalued and worth investing in.
But there are downsides too. If the company buys back shares at a high price and the stock drops, it can be a loss.
And if the company uses cash for buybacks instead of investing in growth, it might not be the best use of resources.
True, it's a balancing act. Companies need to weigh the benefits against the risks.
Let's look at some real-world examples. Company A did a buyback and saw a significant increase in stock price.
But Company B's buyback didn't go as well. The market didn't react as positively.
Each case is unique. It's important to understand the context and the company's financial health.
So, there you have it. Share buybacks are a complex but powerful tool in a company's financial strategy.
And understanding them can give you an edge in the market.
If you want to dive deeper into finance and learn more about strategies like these, sign up now for more insights on AI, finance, and how you can retire early.
Sign up now for more insights on AI, finance, and how you can retire early.